You could buy a home in 90 days or less as a self-employed home buyer. People assume being self-employed is a red flag to lenders, and the truth is, it's not. It just requires a different approach, one most people don't even know exists. But if you don't know how to navigate this correctly, you could waste months, lose out on your dream home, or worse, get rejected after you're already under contract. So I was recently at a wedding, dancing the night away. Of course, rocked out to my favorite song, Shout. And the night was coming to an end. It was a great wedding. Went to the bar to have a glass of wine. And the photographer, I think, the wedding had pretty much ended. And the photographer, who did a great job, came over. It looked like something was wrong. I was like, is everything okay? Naturally, she had no idea why I was striking up a conversation with her. She asked for a glass of wine as well. And she said, yeah, I'm having troubles buying a house right now. Just a lot going on. What a coincidence. I actually own a mortgage company. This is kind of my superpower. So although this is a weird circumstance, tell me what happened. So it turns out this photographer, was fantastic. She does consulting or contracting work for a bunch of different bigger companies. They pay her $10.99 and she does very, very well, to the tune of over $300,000 a year. Sounds great. She's buying a very modest $500,000 house versus the $300,000 that she makes. So I said, I know exactly where this went wrong. I said, are you W-2 employee, doing your own business? Are you a contractor, self-employed? She said, I'm self-employed. How'd you know? And I knew it. This is exactly where it's going to go wrong. Where did you apply? Right away, I already knew what she was going to say. To the bank that she has all her monies with, right? Where'd you apply? Oh, I applied to my actual bank that I bank with. I said, I knew it. You're just probably getting the wrong mortgage. So I'll give an example here very quickly, an illustration of where it went wrong. So she, option number one, and then I'll show you what we did for her, going to the wedding, rocking out to Shout, which then turned into me saving the day for their actual photographer. It's a really cool story, but she's a 1040 self-employed Schedule C. On her Schedule C for 2024 and 2023, let's say she made $300,000 in revenue each year. But that's not what they look at on a conventional mortgage. She was, again, if you remember, $500,000 house. She was actually putting 20% down. She had outstanding credit, so it's a $400,000 mortgage. She had outstanding credit. It was like a 760. Plenty of money in the bank. You would think she gets a loan 1, 2, 3. But unfortunately, she probably had an aggressive CPA and she had a lot of expenses, whether it's equipment for her photography stuff or travel. And, I think she went to various states. So she wrote this down to about $50,000 in profit. So she wrote off $250,000. It's a lot of money, $250,000 in expenses. I think she actually purchased Google pay-per-click marketing. She actually, I think, paid for a lot of Google pay-per-click marketing. She bought a lot of internet leads. She really went for it. This is a very good number for her. But the problem is the $50,000 a year in profit, that's about $4,100 a month of usable income. Assuming no debt, it's about a $2,000 max mortgage payment qualification. So this house, it was in a very expensive area in New York. It's about $20,000-ish a year for taxes and another, let's say, $3,600 a year for insurance. So that's probably about $2,000 right there just for taxes and insurance per month. So what she qualified for just covered tax and insurance. She didn't qualify for the mortgage. So what did we do? We pushed her into the better loan option for her, which is what we're going to talk about in this video, which is if you're self-employed, qualifying in 12 weeks. We qualified her in 12 seconds because I knew right away the better loan option for her is going to be the 1099 program. So she was getting 1099s to that $300,000. So what we did is we did a 2025, which is when I met her, YTD, year-to-date average. We took the 2024 and the 2023 1099s, which were $300,000. And the year-to-date was in line. This is about $25,000-ish a month. The year-to-date was right in line. So $25,000 a month, how do we calculate income? You take 10% off the top, which is $2,500. So $2,500, right? You want to do math like I used to do back in the day. So that's about $22,500 left over. So this is what we give her credit for income. So think about that. She almost 6x'd her purchasing power by going on the right mortgage. So based on the $22,500, she didn't have much debt. She qualified for up to a $10,000 mortgage payment. This mortgage payment was, assuming a rate of 7%, about $2,800 plus another $2,000, right? So $4,800 was the all-in mortgage payment. So she qualified for up to $10,000. There she goes. she qualified. So she was just like most self-employed clients. They think, oh, I'm self-employed, I make all this money, which typically they do. Unfortunately, you don't have to pay a lot in IRS tax. That's why I say unfortunately. It's not unfortunate for them. It's unfortunate for the IRS. And then because of that, the net profit that you show, you don't qualify for the typical vanilla conventional mortgages. So here comes our non-QM product suite, one of which specifically is off 1099. And we're able to come in and save the day. All right, guys. So what I'm going to do now is I'm going to take it from the top and I'm going to show you, if you're self-employed, I'm going to show you how to become from not even pre-approved to a homeowner in under 90 days in 6 easy steps. But first, with the magic of editing, I'm going to have the overview written out by my team because frankly, my handwriting is horrific. All right. So the first step is to organize your income documentation. So what does this mean? Typically, if you think of all the different loan options, so typically on the non-QM, right? If you're self-employed, we're going to specifically talk about the non-QM side. On the self-employed side, there's the bank statement program. There's a P&L program. There's an asset-based program. And there's a 1099 program. So when you organize your income docs, if you're self-employed, and we're going off of your bank statements purely, looking at the revenue, typically, to keep it clean, it's about 12 months. So although it's annoying, shouldn't be all that annoying. You go into online banking, you download the PDFs of your business bank account, you save the 12. But the good news is that after that, maybe you have another trailing month that you'll need, but the income documentation portion of the pre-approval side will be over. So you're going to collaborate that, send it to your loan officer, but that's what we need for a bank statement program. They're going to look at the revenue. They're not necessarily going to care what's left in the account, believe it or not, at the end of the month, as long as it's not a negative. Nobody likes negatives, but that's what we need for the bank statement program. So for the profit and loss program, we're going to need a P&L for typically the last 12 months from the actual previous year up into the end of the preceding month. So for instance, if right now is November of 2025, we would need a P&L from 11/1/2024 to Halloween, 10/31/2025. Now, this is typically something that is put on your CPA or your PTIN, your tax preparer's letterhead, and it's going to show your revenue, your expenses, and the profit. So that's something that you'll want to prepare because just like tax returns, if you're applying for what I'm talking about here, just like bank statements, if you're self-employed and we're working off those, the profit and loss program, that's going to give us the number. That's going to let us know exactly what you qualify for from an income perspective. So that's something you're going to have to prepare and we definitely need. So there is such a thing now as asset dissipation, asset depletion. So really just asset-based lending. So how could that ever work? Say, for instance, you're getting a $1 million loan. There is such a loan right now, believe it or not, guys. That's right. Take a deep breath, let it out, and feel the love that there are these cool loans with great interest rates that are easy to qualify for. If you have 125% of this loan amount in the bank after you close, meaning if you have 1.25 million or above that in the bank after you close, after you get the loan, you qualify. Nothing else is asked for, no bank statement stuff, no P&L. It's just that simple. Now, to be super safe, we're going to ask for 6 months of bank statements to show these type of funds. So again, if they're not going to ask for any type of income documentation, it's all based on assets. They're going to want to assure as anything, make sure that it's there and it's all viable. So 6 months, just get that together. So it's 12 months for business bank statements. The asset-based program gets 6 months of that account. A lot of these accounts typically are quarterly. So the last 2 quarters we'll need. And that's what we need from a documentation perspective for this program. Now 1099, which as we alluded to before, we just need the 1099 or 1099s, an S, for the last 2 years. So call it 24, 23, because we're in 2025. And then for year to date, we just need something showing what you've made year to date for that specific income. So that is step 1. Just organizing straight up your income documentation. All right, before we get into the second step, make sure, guys, go in the description and click the link. We have a self-employed home buyer's guide cheat sheet. It's super cool. It's a cheat sheet to all the stuff we're talking about, and it's free. Who doesn't love free? So go in our description, click the link, get our free self-employed home buyer's guide cheat sheet. So the second step for preparing, and right, this is all based on a less than 90-day from on the couch to a home buyer, basically, right, is going to be separating business and personal accounts. So I bring this up. It's not really a big, or a difficult endeavor, because so many times when we're self-employed, or if you're self-employed, between business and personal. So think of your business, 1, 2, 3 corporation, and then personal, Andrew Russell. So sometimes the personal funds the business. Sometimes the business, you take monies out for the personal, but then you want to say, hey, look at all this money in both my accounts. So just understand conceptually that when you're doing non-QM and you're a business owner, that ideally we're going to look at the business the last 12 months, and we are in fact going to look at the deposits and the transfers. Anything that comes in from the personal side, anything that goes out and comes back in, those don't count as deposits. It's kind of like, trying to beat the system here with some kind of smoke screen. So just understand that when we get into these business-based programs that we're going, typically, right, the bank statement, the profit and loss, 1099, even the asset side, we're going to look at some of the large deposits. Make sure in your head you differentiate and separate your business and your personal from an asset perspective, and you understand that there's no commingling, can't go back and forth. Money come in from personal doesn't count as business income for the bank statement program. So we do allow reviewing personal bank statements for the income side for a bank statement program. There's a lot of guidelines around it. But step 2 is always, guys, just understand that we are going to a little bit of scrutiny if you're including your personal statements, check to see what's going on between obviously the two, and you can't transfer in personal monies and call that revenue. Now, step 3, which some argue is the most important, is you want to get qualified or apply with a mortgage LO at a company who specializes in self-employed or non-QM mortgages. So I always say this, talk this in front of agents when I do C classes for agents, or tell some home buyers on the different options they have to apply for a mortgage. There's 1, 2, 3, 4 types of options, 4 options for that loan officer typically can work. Option number 1 is an FDIC. Option number 2 is a credit union. Option number 3 is a mortgage bank. And option number 4 is a mortgage broker. Now, unfortunately, we save the best for last with a broker, but everyone says like, oh, I have a broker, right? They always throw out that word. Real estate agent, oh, I have a broker. Mortgage person, loan officer, I have a broker. But it's actually misused horrifically. And we're going to show why. So on an FDIC, that's where the loan officer works. Think about an FDIC, right? You have amazing companies, Chase, Wells Fargo, Citibank, Capital One, Citizens. These are places where you typically have your money or your deposits, depository institutions, and they also offer mortgage, and they're exceptional at so many types of mortgage. But for whatever reason, what's the point of this video, guys? If you're self-employed, how to potentially go from on your couch to all of a sudden a homeowner in 90 days or less, getting a non-QM or self-employed based mortgage. These type of mortgages, for right now, FDICs typically are not offering them. So if you apply to get a pre-approval and you're self-employed with an FDIC, typically you're going to have more difficult of a time because they have a limited product availability. So that may not be the best route. Credit union. Credit union is similar to an FDIC. They specialize in all sorts of things. They're great with deposits. They have all sorts of CDs, I'm sure. They have HELOCs that are usually very, very cheap. Home equity lines of credit. Auto loans are great. They as well have not adopted the non-QM space as of yet, so it's not going to be the best option for you to qualify with. So if you're self-employed and you go to get a pre-approval with credit union, you might have a more difficult time just because the full gamut of product suite that we're talking about, it's not available. The third is a mortgage bank. So mortgage banks are actually great companies. Now they are offering non-QM product suites, which is cool, but it's just that one mortgage company. So whatever they're good at or they're pushing is what you'd be eligible for. But sometimes one specific company doesn't specialize in everything. So just because the mortgage bank offers it doesn't mean it's the lowest interest rate or the highest financing point or the least down payment, or maybe your credit score is less than a 700. Maybe they say that you're not eligible, but you really would be if you went to a different company. So mortgage bank is actually a good company, but the best company to apply with is a mortgage broker company. Now, why? So what makes mortgage brokers unique? They're on with all the lenders. They're just the middle person, the broker, but their job is to set you up with the best lender for your specific scenarios, whether it's a low credit, high down payment, non-QM loan, or it's a 1099 program. As we said before, you want a 10% expense factor, so using pretty much most of the 1099, or a profit and loss program where you're going off of a profit and loss and a CPA letterhead and not even looking at bank statements to verify. What makes a broker unique is they will, number one, see who prices the best on the lender side to get you the cheapest rate. They'll shop it around for you for free with all their banks. And number two, they'll do all the work, and typically they get compensated by the lender. So there's no upcharge to you outside of the lender paying the compensation to the broker, which is super cool. They've eliminated the ability on these type of mortgages to get compensated on the self-employed, primary purchase side, for instance, from the borrower, which is you, and the lender. So when they've eliminated and kind of chopped it in half, now brokers are the low-cost provider. So they'll say you have the right lender for your specific scenario, because they're all different. They'll go to the best lender service-wise for your specific, whether it's a profit and loss program or bank statement program or an asset-based program. All while doing that, they'll shop it around and get you the lowest rate. So clearly, step 3 is super important. You don't want to waste your time getting pre-approved with the wrong person or team. So make sure the law officer you work with, number one, specializes on non-QM side, like similar to myself. And number two, similar to myself again, shocker, they work at a mortgage broker company because they'll give you the best experience with the lowest rate. So step 4, which is actually our timeline. So you're going to put together your timeline and then base your expectations off of that. So you have weeks 1 to 2. You have weeks 3 to 6, right? Because we're working off of a 90-day, which is 12 weeks. You have weeks 7 through 8. And then you have weeks 9 through 12, right? Now, this is assuming a market with a decent amount of inventory. But this is if right now you're sitting on your couch, eating a Bubba burger, living the dream, and you're like, oh my God, I'm self-employed. I want to buy a house. Andrew, this is amazing. And you want to start right now. So outside of reaching to my team, this is what it would look like. So in weeks 1 to 2, you're working on your pre-approval. This is when you're going to reach out to, as an example, me and my team. We're going to reach out to your loan officer and say, hey, I'm looking to buy a house, probably going to do a non-QM mortgage. Hook me up. Let's get this done. So what they're going to do is they're going to send their secure pre-approval application typically, or take your information over the phone. You're going to go over your name, date of birth, social, home address. Name, date of birth, social, home address. That gives them the authority, once you say yes, to run your credit. They can run a soft pull, which is cool because it doesn't affect your credit score, but it gives them enough information to issue a pre-approval. So say you're like, hey, I just want to see what I qualify for today, but I'm not looking to buy for another year or 9 months. You do a soft pull so you don't have a hard inquiry forever. So that's what happens when you first reach out and you're trying to get a pre-approval. Then they're going to say, hey, let's see in this whole product suite we went over, are you going to do a bank statement program, a profit and loss, asset-based, 1099? They're going to give you a doc list of stuff that they need. I'm not going to just assume that you have nothing going on in your life. If you're self-employed and a business owner, entrepreneur, you have a lot of stuff going on. I can empathize. It might take you some time to get them the documentation. So what you do is in that first, second week, you fill out the application, you send in all the documentation. The lender, the loan officer reviews, sets up a consultation to go over all the options with you. And typically it could be really fast. If you think about the mechanics, if you have a conversation on the phone, fill out an application, send the docs right there, we could probably show pre-approval in 5 minutes. Does it take 5 minutes? Typically, no, because people get busy, things happen. You're not trying to buy a house right now or the world ends. So if that's the first 2 weeks, that's what you work on, the pre-approval side. Now, weeks 3 through 6, I don't know how old you guys are, but I remember back when I was young, the whole shop till you drop, right? So at this point, that's when we kind of loop in the R, which is the realtor. You're going to start going out, looking at houses. Now, in a perfect world, the realtor lines up 6 to 8 to 10 houses for you in a weekend. You go, you see some, you make some offers, and they get accepted. In actuality, in this market, it's not really happening. Even, weeks 3, 4, 5, 6, that's a month, right? So in the 90 days, getting an accepted offer in a month is still somewhat difficult. But typically in that after the first 2 weeks, month time frame, 4 weeks, you get the realtor, start seeing houses. In a perfect world, at some point, you get an accepted offer. Now, after that, once you have an accepted offer, call that an AO, the fun starts to begin, but it doesn't start just yet. You're going to kind of work through, all right, cool. Depending on what state you're buying in, I'm going to get it inspected. And if there's an inspection, if something's wrong with it, maybe you want to renegotiate. Now, when it's inspected, say there's something wrong, you could either renegotiate the sale price and make it lower. Number 2, the seller could agree to fix it before closing. Number 3, in this market, a seller's market, not a buyer's market. The seller says, kick rocks, either take it as is or don't buy it, I'll sell it to the next person, which could happen. Or 4, even though you pay for an inspection, you back out and you just don't buy the house. There's too many things that are going wrong with it. So say after your accepted offer, after this period, you make an offer, it's accepted. You go through, maybe get an attorney. It's an attorney state. The inspection's good. Now you go into contract. So then that brings you to the last month. So in the last 30 days, this is when the fun happens. So when you're in full contract, that's when the mortgage team, they take the baton, they do the rest. And specifically when they get your initial fully executed contract, which means you signed, the seller signed, and they cash your initial deposit, they're going to send you the initial application within usually a day or so. There's a lot of rules and regulations on when we have to send it to you. They're going to go over with you, make sure you like the terms. You're going to e-sign that initial application, which just verifies, hey, I'm ready to start the process. And then at that point, the lending team you're working with, they're going to get all the documentation they need from you, more stuff potentially than when you first sent to them. Just maybe clean it up, remove some stuff not needed, get some updated stuff. They're going to submit the loan to the underwriting team for approval. While they do that, concurrently, they're going to order the appraisal. And then whether it's the realtor, the seller, the attorney, somebody's going to order the title report. So there's 3 things happening when you're in contract, right? It's like a 3-pronged approach to getting you ready to purchase a house and close. This is you as the individual. We need to get you reviewed and approved based off of your income, your credit, your assets, all the good stuff. There's the appraisal, which is really the property, making sure what you're buying it for, it's actually worth that in a fair market appraisal, where they take your house, they compare it to usually 3 to 5 similar sales. And as your house, as it stacks up to the other houses, typically sold within the last 6 months, is it equal or greater than in value? And if it's less and it comes in for less than what you're buying it for, are you willing to bridge the gap and pay the difference? So if you're buying a house for $500,000 and it appraises for $450,000, are you willing to pay that $50,000 difference plus your down payment, or you potentially renegotiate with the seller? That's the second thing that's happening concurrently. Again, you as the individual are being reviewed. The appraisal is reviewed, which is the property. And of course, the title report. The title report's the third piece. That's making sure the seller who's selling it to you actually owns it. There's nothing strange going on. There's no liens that are against the house. So when they sell it to you, you're going to have trouble taking it over because they have a $500,000 tax lien. So that's the importance of the title report, making sure that there's no open permits or violations, just making sure they really cover you from a title and an ownership perspective. So within the 30 days, typically, this is all happening and completed by week 2. Week 1, the process starts. Week 2, all the magic's happening. By week 3, typically, we're working on all 3 of those items, getting them reviewed by the underwriting team and cleared off, which just means that you're good to go as an individual. The house came in for value. The house is good. And then good to go from a closing perspective. The value's there, no issues. And the title report, no issues, no funny stuff. They're able to sell to you and nothing that would prevent you from closing from a title, taking ownership perspective. Those things happen in week 3. And then week 4, yay. That's cringy, right, guys? So yeah, in week 4, by then at least, that's when you're able to close and you're able to take ownership. So that's the 4th step. So that's just an overview of a timeline. Obviously none of this has happened yet, but just in your head, to have expectations. If you have the timeline mapped out, you have really good expectations and you won't have any, miscommunications with any of your team or the lending team, because this lays out for the future what you would expect. Now, number 5, prepare for underwriting ahead of time. So it's almost like not prepare. It's almost more so like don't make any mistakes that shoot yourself in the foot. Large deposits will be asked about. So if you go to Vegas and you gamble or you have a side hustle, whatever it is, if you deposit over a certain amount higher than you typically make a month. So if you deposit in cash over a certain amount of what you make a month, they may ask about it. Be ready for explanation. You can use those funds. Don't go out and lease another car. That could be problematic as well. Don't go spending your monies for your closing costs by going to Vegas with your friends or whomever. That's actually happened, believe it or not. Big expenses, don't go out and do them or take them or finance things or lease things, because that's going to affect your ability to qualify. And I can't tell you how many people actually have done that. They're buying a house, they qualify by the skin of their teeth, and they go out and they lease a big truck or they spend money somewhere else. So just make sure in the time that you're going to buy, you really hyper focus on that and don't do anything that could potentially affect your ability to purchase. Make sure you're self-employed. You're going to have to warm up your CPA. I can't tell you how many times CPAs give pushback to their clients on letters needed from the lending side or just documentation needed or information. So make sure your CPA is where, hey, I'm going to be buying a house. I'm probably going to reach out to you for some stuff, just like Andrew and the mortgage team will, for instance. Please do me a favor and respond in a timely fashion, because sometimes, although you're ready and we're ready, the third parties that are involved, which is like, for instance, CPA or financial planner, they have to be cooperative. So make sure you warm them up and say, hey, over the next month or so, if we ask for something, I'd really appreciate it if you sent it in time. And of course, the last step is just knowledge, right? Knowing the minimum requirements. So when you get your pre-approval, make sure it wasn't speeded through. And, the New York loan officer like myself talk really fast and all of a sudden he went over, right? Make sure they slow down and they went over everything so you fully understand, because there's nothing worse than going out to see houses and either wasting the real estate agent's time, even your time, your emotions, your family's emotions, finding a house, falling in love, and not understanding what you truly were pre-approved for, making an offer, only to find out you actually don't qualify and it just never was in your wheelhouse. Now you fell in love with it. Your kids saw their potential future bedroom. Now everybody's sad, right? So make sure that knowledge is power and that pre-approval, although you don't do mortgage for a living, make sure you fully understand what you qualify for. And that relates to a lot of different things. Number one, whether you qualify for it, it's another thing if you can afford it. We talk about it all the time. So affordability is what the payment is. Can you afford it? Qualifying is what we can give you a mortgage for. So for instance, just because I can give you a mortgage for $10,000 a month doesn't mean that you should take the $10,000 a month mortgage. What if $6,000 a month is more your sweet spot? So $4,000 difference, it's a lot of money. So just make sure for the knowledge side of it all, which is really then getting off the couch and you're going to start this process. It's understanding what can we afford where there's still money left over every single month, where we can still go on date night, bring our kids on vacation, the house, something goes, the roof, the boiler, God forbid, we have monies there. We can still live our life and we're not paycheck to paycheck with a really cool house. And if one flat tire happens, we're basically screwed. So that's a big piece as relates to the pre-approval. Of course, down payment. Now, when you buy a house, newsflash, there's closing costs. So sometimes you say, hey, I have 20% down, which is the program minimum. But then they go into contract, and then for whatever reason, like, oh my God, another $20,000, $30,000 in closing costs? I don't have that. I was never told that. Well, typically they are told that, but it's hard to conceptualize when you think, hey, I'm going to buy a house and put 20% down. It's not just 20%. There's closing costs as well. So make sure you get an estimate from your loan officer that shows all the fees, nothing hidden, it's a very regulated business we're in. Everything that you will come to expect in the future, we have to show you. And if we make a mistake, there are some fees we actually have to pay for ourselves, which is pretty crazy to think about. But make sure you get a fee worksheet from the loans you're working with so you have knowledge around the down payment and also the closing cost expectation for a true out-of-pocket. And lastly is a time frame expectation. So this comes really from the real estate agent, depends on what market you buy. Florida, South Carolina, even California. Some of these markets, the closing process is fast. Some of this 1 to 2 week, 3 to 6, 7, 8, 9 through 12. It's actually a little bit more abbreviated because of the state you're buying in. Now, New York, unfortunately, New York, what a great state. The closing expectation is literally a hot mess. Why? You go into contract and there's no idea of when you're going to close. It could be, there's this whole on or about thing. That's like a 30-day hedge from the closing date. So if it's on or about 60 days, that means that your closing could happen, not will, could, within 60 to 90 days. And if it doesn't happen in 90 days, people start getting upset, but nothing really happens. And why is this problematic? What if you're in a rental? What if you're leasing? What if you want to set up moving trucks? There's really no specific closing date. So just know before you go, the knowledge side of an expectation of closing, state specific, for instance, New York. You just have to understand that, some of this stuff, it's not going to be specific and 100% accurate, but it really, if you have kids, school districts you're trying to get into, it really will shape how the future looks. So from a knowledge perspective, the last piece is just from an expectation of closing, depending on what state you're buying in, make sure you have a really good real estate agent and they let you know, hey, with this accepted offer and going to contract, a true idea when you're going to close is as follows. So you could time moving trucks and just time your emotions. All right, guys. So make sure you go in the description and click the link before you sign off this video. We have a really amazing self-employed homebuyer cheat sheet. So make sure you go in the description, click the link, and make sure you get yourself a free copy. So now that you know how to buy a home in 90 days or less and you're self-employed, make sure, guys, you watch our next video, how to avoid the number one mistake of self-employed clients with non-QM loans. So click on it. How to avoid the number one mistake in 25 minutes or less for non-QM loans for self-employed clients. Make sure you click on the video and watch it.